Hey, I'm Fool.com editor Nick Seipel, and on this episode of FAQ, we're answering the question you've all been asking. How do you make money in the stock market? People invest to make money, plain and simple. Except in special circumstances, like shorting a stock, investors buy a stock with the hopes that it will increase in value, allowing him or her to sell the shares later at a higher price and pocket the difference as profit. But how do we know that a stock is going to go up before we buy it? In the short term, stocks go up or down for an endless number of reasons, from military conflict and news releases all the way down to individual tweets. However, there's only one reason a stock's price increases or decreases over the long term: to match the value of a company's assets and cash flows. As Ben Graham famously said, in the short run, the market is a voting machine, vacillating based on the news of the day. But in the long run, it is a weighing machine, measuring the actual value of a business. Now that we know why a stock's value increases over the long term, we can answer how to make money in the stock market. There are two ways to make money in the stock market. You can either buy a company for less than it's worth, or you can buy a company at fair value and hold it as it continues to grow over time. Let's look at each of these in turn. Imagine I offered to trade you a $1,000 car for $500. Would you take it? Most of you probably said yes. Free $500, right? You know, you can take that car and with patience and effort, find a buyer for the car's full value. Maybe the seller didn't want to put in that effort, didn't know what the car was really worth, or for whatever reason, they needed the car gone quick and they decided to sell it to you for that reason. This same thing often happens in the stock market. A stock falls out of favor, whether due to bad news around a company, market volatility, or really a number of other reasons, and its price falls below what the company would be worth to a reasonable purchaser based on its earnings and assets. Intelligent investors can take advantage of these opportunities to purchase shares of a company for less than it's worth, and just like with the car, sell the shares for a tidy profit once the market realizes its mistake. Also like the car, it may take a long time to find a buyer, because markets can remain irrational for a long period of time. However, this strategy has been among the most successful in the history of investing. This approach